I've recently been buying loads and loads of this newer income-focused ETF offered by JP Morgan called JEPQ, and this is for multiple reasons. This ETF not only offers a massive starting dividend yield, but also the potential for major capital appreciation long term. Now in this video, we are going to explore why the JEPQ ETF is so much better than other similar covered call ETFs in the market, things like JEPI or Q Yield, at least in my opinion. And also stick around until the end of the video, because we're going to go through the exact math and see how long it's going to take for my $20,000 investment that I made as of recently into JEPQ to compound all the way into hundreds and hundreds of thousands of dollars worth of the ETF. Now we're going to go through all this and more right after you please drop a like in this video and subscribe for more content like this. Now first off, let's talk a little bit more about the JEPQ ETF and what the ETF has to offer. JEPQ invests in public equity markets and invests directly through derivatives and stocks of companies across a diversified sector. Now JEPQ uses derivatives such as options to create its portfolio and invests in growth and value stocks of companies across diversified market capitalizations. Now to look a little bit deeper into JEPQ, let's head over to the JP Morgan website. So over here on the JP Morgan Asset Management website, it says JEPQ NASDAQ Equity Premium Income ETF, and the fund's overview is pretty simple. It says that JEPQ generates income through a combination of selling options and investing in US large cap growth stocks, seeking to deliver a monthly income stream from associated option premiums and stock dividends. This fund also seeks to deliver a significant portion of returns associated with the NASDAQ 100 index with less volatility. Now lastly, this fund constructs a long equity portfolio through proprietary data science driven investment approach designed to drive the portfolio allocations while maximizing risk adjusted expected returns. Now what's kind of cool about this is they actually have the entire investment process laid out on the JP Morgan website. So in more detail, it says that applied data science processes utilizing 40 plus years of JP Morgan proprietary data to create a fundamental framework for security selection and portfolio construction. That's number one. That's the underlying equity portfolio portion of this entire investment strategy. Now with that, an option overlay. When it comes to options, 1 month out of the money call options designed to generate income and give investors a portion of the upside with reduced volatility. And with this, it equals JEPQ, a well-represented, fundamentally driven NASDAQ 100 strategy that seeks to provide clients with a monthly distributable income via option premiums and dividends. Now some more facts about JEPQ. The fund has only been around for about a year and already has over 3.4 billion in assets under management. The fund's price is actually down since inception around 1.14%, so pretty much back to where the ETF started around a year ago. Now JEPQ's expense ratio is pretty much industry standard, or even maybe on the lower end for covered call ETFs for at least what I've seen, at a 0.35%. So this ETF does charge you quite a bit more than something like SCHD, but of course it's because the strategy is much different and more hands-on. Now here we have the most important portion of this ETF, and this is exactly the reason why I've been purchasing tens of thousands of dollars worth of JEPQ as of recently for my long-term dividend growth portfolio. It's because of the holdings breakdown and also the top 10 holdings, which we'll go over right now. So looking at the top holding breakdowns, JEPQ has technology at almost 51% of the entire fund. Now in comparison, for example, JEPI, JEPQ's brother or sister, has only 17.34% of their entire breakdowns in technology. So you might be asking yourself, well, what's so special about technology and why does JEPQ have so much of its overall holdings based in it? Well, the great thing about tech stocks in general is that they're known to potentially deliver significant growth. With technology advancements and innovations that are continuously going on, there is crazy opportunity in the market to make a lot of money and some major moves in the technology sector. Now with the JEPQ ETF being so heavily invested in technology, it is definitely going to have a much higher beta. Now market beta, also known as systemic risk or equity beta, is a measure of a stock or portfolio's sensitivity to the overall market movements. So beta is a commonly used term as far as risk indicator. A beta of 1 indicates that the asset or portfolio tends to move in line with the overall market. If the market increases by 1%, the asset or portfolio is expected to also increase around 1%. Now with JEPQ's holdings being majority technology, that means that this ETF is going to have a much higher beta, again compared to something like JEPI. Now this can definitely be a good thing, of course, when the market moves up. But when the market moves down, once again, something with a higher beta than 1 is also going to move down more significantly. But with JEPQ's top 10 holdings being things like Microsoft, Apple, Alphabet, Nvidia, Amazon, Meta, and Tesla, this ETF's holdings might have a little bit more risk as far as downside, but the upside potential, in my opinion, can be much, much larger. And when it comes to JEPQ, the upside is not only from capital appreciation. JEPQ also does pay a massive dividend on a monthly basis, or at least it has historically speaking. The most recent dividend from JEPQ was 36 cents per share. The one before that was 48 cents per share, 45 cents before that. And since inception, JEPQ's pretty much paid around the high 30s to around 50-60 cents per share per month. Now, with the previous dividends paid, this gives JEPQ a 11.8% trailing 12-month dividend yield, which is obviously very hard to find a dividend yield even near that. So because of JEPQ's potential for massive capital appreciation in the future, because of the higher beta, high quality basket of holdings that this ETF has, and on top of that, the significant consistent dividend that JEPQ has paid since inception, this ETF for me personally is a perfect staple to have in my long-term dividend growth portfolio. Now, if an investor, not like myself, is not all that interested in getting paid on a monthly basis and wants to invest into an ETF with higher overall growth potential, well then JEPQ might not be the right investment vehicle for you. But for the investors out there, like myself personally, that are looking for a high quality ETF with rock solid holdings that pays a great dividend on a monthly basis and also has the potential for some massive upside, JEPQ is definitely an ETF worth looking into. So now that we know everything about the JEPQ ETF and you now fully understand my take and why I've been smash purchasing so many shares of JEPQ as of recently, let's go through this dividend calculator, input all that JEPQ has to offer, and see where my investment will end up long term. So if we were to input the starting principal of what I own of JEPQ, $20,000. Now throughout all my portfolios, I think I own around $20,000 worth of JEPQ. It could be a little bit more, it could be a little bit less, but let's just use 20K as an example. Now JEPQ's initial dividend yield, 11.8%, which is the trailing 12-month dividend yield, which keep in mind the dividend yield for covered call ETFs is definitely going to change pretty consistently over time. But for this example, let's just use the trailing 12 months to keep it simple. Now the distribution frequency for JEPQ is on a monthly basis, obviously. And because I do plan on reinvesting my dividends at least for a while still, let's turn DRIP on. Now since I'm currently 30 years old, let's use 30 years invested to see what we would have after 30 years when I'm 60 years old. So if we go through the dividend calculator with the $20,000 or so of JEPQ that we're starting with, which is what I currently have right now, and if we were to get paid the dividends and reinvest the dividends and not add a single penny more into this portfolio, by year number 2, we would have $22,718. Then if we got paid dividends from that, reinvested everything, by year number 3, we would have over $25,000. And what's crazy about an ETF like JEPQ is that the annual dividend amount is so much right off the bat because the starting dividend yield is obviously so darn high. But if we were to skip forward by year number 15, just with this $20,000 investment and with reinvesting the dividends, this portfolio would already be almost to $100,000 worth of JEPQ and over $7,600 a year in dividends. This portfolio would be worth around $325,000 and earning around $16,000 in annual dividends. And once again, this is just with a $20,000 investment of JEPQ. But I want to hear what you guys think down below about covered call ETFs in general. And what are your thoughts about this newer covered call ETF, JEPQ? If you enjoyed this video, make sure to please drop a like in the video and subscribe for more content like this in the future. Thanks as always, guys, and I'll see you in the next one.